here to talk about the final part of our 5-piece series on the crypto investment journey. And this piece almost tends to be one of the most seminal pieces because today we're going to be talking about exiting the crypto markets. You know, it's all good and well investing in the right place and having the right strategy from the beginning, but if the exiting part of it is not done properly, or the exit isn't done properly, then it can really lend itself to a lot of mistakes being made. And some of the kind of saddest stories that I've heard have been those where the person made the biggest mistakes in exiting and ended up losing money or not manifesting the gains that they'd actually made in the market. So what we're going to talk about today is basically all the pieces necessary for you to understand the process of exiting, but also how to strategize that exit. Because again, we always go back to strategy. Strategy is the thing to do. That's how you succeed in life. Goals and plans. So before we start off, one thing I really always want to make sure that you keep at the forefront of your brain is remember that 30% drops are part of this market. That this is a highly volatile space that you're playing in. And every time you see a 30% drop, you shouldn't be thinking about exiting and thinking that it's the end of the market. If you are feeling that and you are in that state of kind of not knowing, and every time you see 30% of your portfolio get wiped off the map within a few days or a week or two, and you feel that anxiety, that's coming from a place of not knowing the bigger picture and not understanding the dynamics that are causing this market to have these fluctuations of 30%. And, it goes 30% down and then it can go hundreds of percent up. You really need to understand why that's happening. And of course, if you've seen all the previous pieces in this series, you have a complete understanding or a wholesome understanding of why the markets are doing what they're doing, the Bitcoin halving and the cyclical nature of these markets and the 4-year cycles that they follow. So when you are participating, just remember that 30% drops are great. 40% drops are something you definitely do need to pay attention to because they're unusual. Something like a 50% drop is alarming because historically a 50% drop comes after the market has actually peaked. So that's kind of a good way of looking at it. That should give you an idea that if you see a 30% drop, that's a healthy part of the crypto markets, and that isn't a time for you to just run for the hills. So let's just look at for a second how to understand when to exit, because it's really difficult for you to have an exit plan if you don't know when the markets are going to peak. Now, nobody's going to be able to tell you that for sure. Nobody's Nostradamus. But statistical data analysis will give you some semblance of an idea of how long these markets take to peak. So remember we talked about how the reason why the price of Bitcoin spikes in the first place is the Bitcoin halving. Half of Bitcoin is produced. The value of Bitcoin goes up due to increase in demand and lack of supply. And when you look at how the previous cycles have performed, there's one great little tidbit in there that you can look at to really give you an idea of how long you're expecting this market to run. So every single time that we've had the bottom of the market, which is effectively the lowest price that Bitcoin has sold at, and by auxiliary, these same kind of patterns apply to the rest of the coins, but we're just going to talk about Bitcoin because that one's easy to understand. But when you look at when Bitcoin was at its lowest price, and you look at the number of days it took to go from the lowest price to the Bitcoin halving, it was almost always exactly the same amount of days from the Bitcoin halving to the day the Bitcoin was the highest price. I'm going to say that again because it gets a little confusing. So from the lowest price to the Bitcoin halving was the same time as the Bitcoin halving to the highest price. So then you can start to kind of predict, okay, so if I know when the price was the lowest and I know when the Bitcoin halved, which was in May of 2020, and I know the number of days, then I can apply that same number of days forward from the Bitcoin halving to kind of have an idea when the market's going to peak. Is it going to peak then? Nobody knows. But statistically speaking, it hasn't varied more than a week. So if you are a kind of believer in that philosophy, or at least for me, statistics and data are the only thing I have to go off of. So unless the market tells me something different, that's what I'm going to go with. If you take a look at the Bitcoin halving and you calculate the same amount of days forward, the projected top of the market seems to be somewhere around end of September for Bitcoin and somewhere around end of October for the rest of the coins. Again, this is not financial advice. This is not investment advice. I'm not a tax advisor. I'm not an advisor of any kind. I'm just your friend. I just like telling you these things. So don't just go do things just because you heard this from me. Definitely do your own research. And if you come to a similar conclusion, great. So the reason why I'm saying all of this is in order for you to know how to exit the market, you should have an idea of when you're projecting the top to be. So you can take your profits along the way in a very strategic manner. So if you have that idea of the bigger cycles that, the Bitcoin halving happens after a certain time after that, the market peaks, and a certain time after that, the market's gonna fall down. Then ideally, you want to be taking your profits in that window of when you invest up to when it's projected to top. So let's just take the concept of it's projected to top around the end of September for Bitcoin, right? So what a lot of people would want to do is put their money in and actually just wait until September and then take it out. Because, in our minds, we tend to think about things like, I want to take out the money as close to the top as possible. What most people think is, I want to take out the money at the top of the market. The day it's at the top, that's when I'll have to make the most amount of money. So that's when I want to take it out. That's actually one of the bigger mistakes, because there are two main ways that you're going to miss out on the gains or you're going to lose money in this market. Number one, pulling out your investment too early because you didn't have the patience to wait until the gains. Number two, pulling out your investment too late. So let me explain that. When Bitcoin was $3,000, you didn't want to get into it because you were fearful of getting in. What people do is they'll get in at a time when they see the price go up. So when it was $3,000, you're too scared. When it went up to like $10,000, you wanted to get in. So you got in. You saw it go up to about $20,000 or $30,000. This is just an example. But you saw it multiply multiple X, not knowing these bigger cycles, not understanding the dynamics. And then you're like, hey, I've doubled, maybe tripled my money. And you pull out your investment. But it has way farther for it to go. So effectively, you lost most of those end gains that you would have made, right? So that's pulling out too early because you're fearful about losing the money. So you withdraw it while the market has a lot further to go. The other side, the pulling out too late, tends to happen when you invest and you see it go up and you start to get euphoric about it. Again, all of these things are tied to emotion. That you start to get euphoric about the idea. You start to feel fantastic that you're making all this money. So then greed creeps in and you start to feel like, I want more. And it goes up further. And you're like, I want more. It goes up even further. I want more. One day it actually just falls off of a cliff. And because you're so used to having these regular drops, you don't think much about it. You're like, I want more. But if you understood the bigger dynamics, the larger kind of picture of the market, you would understand, hey, the market's actually, this isn't just a regular drop. The market's actually peaked and it's gone beyond that. So you'll be sitting there greedy, wanting more, but the market will have already turned, and then it'll, drop another 50%. So you basically lost most of the gains that you'd made. So either you pull out too early or you pull out too late. Those are the two things that you want to make sure your exit strategy is set up to help you avoid. So how do you avoid that? The best way to, there's no best way, but here's a great way that I've seen that works really, really well. You need to have a strategy that really looks at your level of risk tolerance and your level of what kind of gains are you willing to get out of this market? Because some people, it's more than enough to actually double your money and pull out your initial investment. Because the point is, if you're putting money in, the point is not to lose your initial investment. That's the biggest piece that we're trying to achieve here. The making money comes out of that kind of game plan, right? So step one should be you have a strategy that makes sure that you don't lose your initial investment, okay? And that has to be done well before the market peaks, or that projected end of the market. Now, here's another great little tidbit. When you look at the history of these markets, most of the gains are actually realized in the last month of this market. So, you'll get in now, and let's say it's 6 or 9 months down the road. For most of the months, it'll kind of be trending upwards. You'll make some, you'll kind of, see it maybe double, maybe triple, who really knows, but it'll kind of go up steadily. And in the last month, things just go parabolic. So you'll see returns that you may not have seen the whole year happen within just the last month. So if you do pull out way too early, you are not waiting until that last month to get the returns. But then if you don't pull out anything by that time, then you're really leaving yourself exposed, because you have all this money that you've risked and you haven't taken any of it out. And when things do go parabolic and you're sitting there on a lot of gains, then you are risking the fact that the market could drop off and you could lose that initial investment that you have in there. So your strategy needs to be set up so that it saves the initial investment that you have well ahead of that parabolic rise. It allows you to be able to have a strategic plan, so you have steps set up along the way. So if you're projecting the market to kind of go parabolic at a certain period, then as it's going parabolic, you're taking profits all along the way. You're not waiting for the top. You're taking some at the bottom, some a little bit kind of midway, some when things start to go up, and when things just go completely crazy and you're seeing double, triple returns within a week, then you really start to increase your speed of how quickly you're taking profits. So what's a good way of knowing which way the market's moving, right? Because we can use stats from the previous cycles. That's one way of doing it. It's a good way of doing it. But in this cycle, there's actually ways for you to be able to understand which moves you should be making and which moves you shouldn't be making. Now, going back to the same point about we don't want to be making moves that everyone's making, right? So then you can statistically analyze what are the moves everyone's making. There's a lot of data analytics in this space because this blockchain is completely open, so anybody can run analytics on it. So when you're running the analytics, you can actually see that the average people are behaving a certain way, whereas the people with lots of money, we call them the whales, they're behaving in a completely different way. So you're able to follow the moves of the whales and not follow the moves of the average person, which again lends itself to you making the returns that the whales make and you not losing your money the way that the regular people make. So that's a great way of doing it. Of course, now, so we're talking about, exiting the crypto markets. This is an exit strategy. But what does that even mean? What does that even look like? Normally when you're thinking about it, if you put money in stocks, exiting means you pull your money out and take it into your bank account, right? That's an exit. In crypto, you don't necessarily have to pull the money out into your bank in order to be out of the crypto market. You don't have to completely sell things for the currency that you have in your bank account and put that currency into your bank. What you can do is you can effectively, let's say you have Bitcoin. Bitcoin goes up somewhat and you're like, I want to turn it back into dollars. You can turn it into a stable coin that's tied to the price of $1. And all a stable coin is that one coin is equivalent to $1. So it's like you've left Bitcoin and turned it back into dollars, but it's still within the crypto sphere. You're still in the crypto market, but you're no longer fluctuating up and down the way the actual crypto assets are doing. So when we're talking about exiting, what we're saying is you exit Bitcoin, but you go into, let's say, USDT, which is called Tether, or USDC, or BUSD. There's a bunch of different ones, but the point is they're all tied to the price of $1, and you leave your crypto asset for this coin that's $1, so you're no longer going up and down. You officially have that many dollars equivalent that you have made now, So that's what an exit looks like. Now, when you're talking about having a strategy as far as you know, if you invested a certain amount of money and you have to have set points where you're pulling out that money, let's say you invest $10, you know, and soon as that $10 turns into $50, you would want to pull out your $10, something like that, right? Soon as it turns into $200, you would want to pull out a certain amount. As soon as it turns into something else, you would want to pull out a certain amount. So you have these set steps, which you can say like, hey, if my $10 turns into 100, I'm good to pull out $30, you know? It all depends on how risk tolerant you are, how you feel about it. Because for somebody who's putting in $10, $30 may not feel like a lot. But for somebody who's putting in $100,000 and you pull out $300,000, that feels like a lot. So this is where the strategy comes in again, where you need to understand what is your level of expectations and returns from this. What feels good for you? How safe do you want to play it? And that would determine these points, these set points. When my initial investment becomes something else, I'm going to pull out a certain amount. That's one way of doing a strategy. A second way that is really important to keep in mind and almost becomes the most important in the last month of these gains is you need to understand that, you know, if the market is going to go parabolic within the last month, then you may not have time to wait for it to hit a certain amount and then pull some out. What if it goes up and you never hit the point that you are waiting for, and then it just crashes back down and you just never took anything out during that period? So when the market is going to go parabolic, you need to understand that you need to be pulling out certain amounts kind of regularly. Instead of waiting for a point to get hit to take a certain amount out, you're saying, okay, this market is way too hot. It's getting crazy. It can't be sustained like this. There has to be some kind of crash. Also, your analytics are telling you that. So when you're doing statistical analysis, they're telling you that. There's also psychoanalysis that gets done, because again, this is a psychology market. All markets are psychology. But when you do when you do psychoanalysis, you can see, okay, the psychology of the market is at a place where things are in a state of euphoria. So one great thing that you should look at, and you know, if we're working together, we'll definitely be looking at, is the Bitcoin psychology chart. I'll wait for you to go Google that. Pause this and go look up Bitcoin psychology chart. That will really give you an idea of how the psychology in each kind of part of this cycle is tied to how people react in that part of the cycle. So as soon as we get up into the thrill and euphoria part, which is basically saying like, as soon as everybody's euphoric that they're going to make tons of money and this is just so easy and we're all just going to keep getting rich forever, as soon as the market goes into that, as soon as the masses go into that kind of psychological state, remember that is probably the point where the market will collapse, because it'll happen when everybody's least expecting it, and you know, people who don't even have knowledge think that they can get really rich from this. So if you do psychoanalysis, if you follow the moves of the whales, the biggest guys in this market, if you do statistical analysis, if you have a strategy from the beginning that you're using to kind of guide you in a certain direction and know which steps you need to take when, all of those things put together can really, really supercharge your ability to be able to make money in these markets while not falling privy to the traditional mistakes that most people make. Because again, most people either pull it out too early or pull it out too late. So that's basically an overview of you exiting the market. You know, you have a plan for exiting, you pull it out into stable coins. Now what do you do? Because let's admit it, we all need cash to live life, right? So now what do you do with those stable coins? You know, so those stable coins are equivalent to dollars effectively. Then it again depends on your strategy. What is it that's your longer plan? You know, when we'll sit down and strategize, we'll always discuss what is your bigger plan with this. Are you know, what is your 4-year? What is your 10-year plan? With those plans, you will need to use those stable coins in a certain way. Some people are investing for the longer term. So, if you understand that this 4-year cycle of this market means the market goes up and then it crashes back down and then it kind of stays sideways for a while and at the bottom of the market, then if you're investing for the long term, the smart thing to do would be to actually invest at the bottom or somewhere close to the bottom, take out your profits on the way up and of course close to the top, wait for the market to actually crash back down so things become super cheap again, and then use those stable coins to buy back into the bottom of the market. And then you wait for the next cycle, which is going to be in 2024. That's great. That's one thing that you're doing with it. There's some people who hold on to it and they do yield farming. And we've kind of talked about yield farming before, but it's basically getting interest. Like, hey, I got this money sitting here. I don't want to reinvest it, but I don't want to pull it out into my bank account. So what I do is I actually lend it to somebody so they actually give me an interest rate on it. That's one way of doing it. Now, somebody else might be like, hey, I'm good. I made this money. I want it back in my bank account. So then that process actually requires you to have good off-ramps. So we discussed on-ramps in one of the previous videos, but we call it off-ramp. The kind of the platforms that you use to be able to get your money back into your bank account. Now, that could look like, you selling the assets on an exchange. So you sell the crypto on an exchange, and then the exchange is just bank transferring back to your bank. But that tends to be okay if you're doing, a few $1,000s. But remember, if you move more than $10,000, it can come with a lot of difficulties as far as getting flagged by your bank and having to explain where this money's coming from and all that. Now, if you're trying to move significantly larger amounts of money, even than that, like hundreds of thousands of dollars, then it really becomes problematic because you have to have banks and structures set up in a way so that you can actually pull out that much money and show them, hey, this is coming from crypto, and your bank's okay with it. And this really, again, depends on your particular situation, because there's a lot of banks which will almost always flag your transactions and sometimes even shut down your account and block your account over these kind of transactions because they're trying to avoid money laundering, whereas other banks are used to these kind of transactions. So you have to figure out ways to actually get your money off and get it into your bank without causing issues or getting flagged or having other checks that you may have to go through. To that effect, it's really good to have multiple off-ramps set up. Never just depend on one exchange. Never just depend on one bank. Never just depend on one place to be able to get it off. It's good to have many exchanges that you can get it off of. It's good to have many different ways to get it off. It's also good to have many different kind of backup plans for you to be able to spend your crypto. For example, you can get crypto debit cards these days where you can actually spend the crypto directly. Right? If that is your strategy, then you can spend the crypto directly from your crypto account rather than having to deal with a bank. That's it. That's a good off-ramp. That's one that I always recommend as a backup. There's also ways for you to never spend your crypto. This is another kind of mind-blowing part of this market, but this is actually a common practice that's used by the high net worth individuals where, if you're building assets and you are growing your wealth in this cycle, and then you're able to invest back at the bottom and hold a bunch of assets, and in 4 years they're going to pump up again and they might go 5x, 10x, who knows, some number of x's, then it doesn't make sense for you to spend it today, because in 4 years it would be 5 times what it's worth today, or whatever times worth it's today. So those individuals, what they do is they'll actually not spend those assets, because like if you own a house, you don't want to spend your house to buy coffee, right? It's actually better to get debt against your house and buy coffee. So there's strategies that actually cover that piece, where how can you keep accruing your assets and still be able to generate cash against it. Those get pretty complicated, so I'm not going to just go into the details of that. But there are those kind of options where you can get cash and you can not have to spend your assets. Depends on where you are and what fits better with your needs. Now, one big piece that a lot of people don't think about is tax. Like, you sold this crypto, and now you're transferring it back into your bank account and you're planning on spending it, have you considered your tax liability? Because you should have a tax strategy, or at least an understanding of what your tax liabilities are, when those points are that you would actually be charged tax, right? Because one big kind of misconception in this whole sphere is that, oh, if I buy crypto, there's no tax. Okay, that's true. If you buy crypto, there is no tax because you're investing effectively. But people think, oh, but if I just exchange to another crypto, then there's no tax, right? No, there is. Anytime you exchange to any other crypto, there's tax. Anytime you exchange to a stable coin, that you owe capital gains tax. Anytime you pull it out back into your bank account, you would be owing capital gains tax on whatever kind of gains you made in the market. So make sure you're cognizant of these things. How are you going to do your taxes? You know, like if you traded in and out of the market 100 times this year, and now at the end you have to track your capital gains for all those things, and like you have to do taxes, and you haven't even thought about that. You might have to pay an individual a ton of money to actually do that. So make sure you've planned for that ahead of time. I'll give you a little tip for that. There's a lot of good AI-based tax softwares. So you basically just attach your exchange to them. They do all the analysis. They give you a nice little report with your tax liabilities and save you the trouble of having to pay somebody thousands of dollars to do that. So that option does exist out there. But part of the exit strategy is also understanding that when you do exit, in whichever way you're planning on exiting, there is going to be a tax liability, and preparing for that and making sure you're taking care of that properly. So that kind of covers how to understand when to exit, how to make sure you don't exit too early, how to make sure you don't exit too late, and your taxes and kind of the whole thing. So the final piece that I really just want to hammer home is like, planning these things ahead of time may seem like it's cumbersome, it's a lot of work, and you a lot of times we have that mindset of, I'll think about it when it becomes a problem. But laying the groundwork ahead of time will be one of the most beneficial things you'll do, because a lot of these pieces you can start executing ahead of time, right? If you have laid out your entire exit plan before you even get in, or right when you get in, then it lends itself to you seeing the whole journey. You know what you're planning. If you've done some analysis, or at least you have trusted sources for analysis who are showing you and guiding you in the right way, then you're able to understand what's going on in a way so you're confident in this investment, but you also know the end goal, and you also know how that's going to be achieved. And ideally, you've written it all out, and it's in black and white as to what's going to happen. Now, could things happen differently? Of course, it's life. That's just how it goes. Nobody can for sure tell you something's going to happen exactly like that. But having that plan from beginning to end, that at least gives you a full playbook of what pieces you should be doing, when you should be doing it, what pitfalls can exist, how to avoid them, that is worth its weight in gold. And in the long term, those are the things that differentiate the real investors from the kind of, we call them retail investors, where somebody's just going in without knowing anything, and the probability of them losing money is high. Somebody who has a strategy, a plan, has knowledge, and can back it up with analysis really is kind of setting themselves up to be successful in these markets. And over the long term, learning all of these skills and becoming self-sufficient and not just leaving it up to somebody else is the most valuable thing you'll have, because this same cycle is going to happen in 4 years, it's going to happen in 8 years, and it's going to keep happening like this. Obviously, this cycle will be the most profitable, according to my projections. Who knows what's going to happen? But this cycle will be the most profitable. Next one will be somewhat profitable. By the one that happens in 2028, things will level off a lot, and the kind of returns that we're getting today will be, a thing of the past. So if you made it this far, thank you so much for listening to all of this. You are taking a big step towards your future. I really appreciate you doing this. And now, hopefully, you are ready to set up your strategy and take hold of your future. So thank you for your time. Thank you for your trust. Much love. I'll see you later. Bye for now.